We all know that we're actually in a recession. No matter how much they want to change the definitions and try and push off recession, we are in a technical recession. Two negative quarters of GDP back to back. That's all it takes. That's what we got. And, everything is majorly expensive. People don't have disposable income. The economy is not strong. Everyone knows we're in a recession besides, the media. But even that's starting to turn, as you can see, Bloomberg is given a 100% chance of recession in the next 12 months. It's kind of funny that they're still talking about recession in the future. We're in a recession now, and the only thing we're going to get from this by pushing off recession, changing the definition and everything, is that it's going to be a major recession. It's going to be massive and rock the financial world and rock everyone's life because they're ignoring it now to push it down later. It just doesn't make any sense. Like, you can change the definition of recession all you want. You can't change the definition of people needing to eat, have shelter, food and gas, and all this energy. Those costs skyrocketing and people not having savings and going into debt. You can say that that's not a recession all you want, but it's terrible. So you can push recession to the offside, but people not being able to buy simple things is still happening. And even banks are gearing up for losses on their loans that they've given out. So, like this says, despite healthy consumer spending, bracing for the impact of economic slowdown that may yet become a recession. Again, is trying to say, like, become a recession in the future, maybe. I don't know why the media and everyone keeps pushing this down. We're in a recession now. Everybody knows it, but banks are gearing up for the losses. They're gearing up for people to stop paying the debt because obviously, if you got the choice between buying food or paying off your debt, you're going to buy food and just kind of toss your debt to the side. And that's what banks are going to have to get ready for. So it's just crazy that things like the banks and companies have to look forward looking, where the Fed can or makes their policy decisions based off of backward looking data. So when they're raising rates, they're not really looking to the future of what could happen and the effects of that. They're looking to the past and trying to fix what the data says about that, even though they might over tighten and make things crash and burn and maybe something breaks, but then they're going to get the numbers they want and they're going to swing all the way back to easing, print a bunch of money, flood the market. That's usually what happens in this pendulum here, where it swings over to one side. They overdo it, and then it's going to swing back to the other side. They're going to overdo it again, and it's just going to keep doing that. And everything that the Fed does has global effects. Obviously, the dollar is a global currency, and we can see that in China, where they delayed the release of their major economic data for the third quarter without a reason or a new date. So even China is having so much problems that they aren't putting out their numbers, and everybody knows that you don't trust the Chinese numbers on their own stuff. They can't they make up numbers. It's not super reliable. If China puts out a data set, you stay a little skeptical and, don't actually just blindly believe everything that they say. I don't think anybody does that, but even China, who lies about their numbers, is having to figure it out, because if they came out and said everything was great, people would look at other kind of metrics of their global trade and stuff and say, it doesn't add up. So even China in trouble, you got the UK in trouble, you got Japan in trouble. There's something major that could collapse and break, and the Fed is just doing its own thing, raising interest rates and strengthening the dollar while the rest of the world kind of crumbles. 76% of adults are making lifestyle changes to prepare for a potential recession. There you go again. Potential, future, not right now, but this could be a self-fulfilling prophecy, like kind of like inflation, where if people are preparing for high inflation, they spend the money now. That can push inflation up higher and kind of make that inflation so it's self-fulfilling. This could also be the same type of thing where people are preparing for a recession. By preparing for a recession, they actually cause one, and we're already in one. So, I mean, they can't do much worse, but it could cause things to continue getting worse. So the money that they're slashing is definitely going to obviously affect the entire economy. You got them delaying major purchases like a home or car. That's a big one. And we can actually see how this is affecting, overall markets. Everyone knew the car bubble was going to pop, but because people are super not spending money right now, you can see that the car bubble has actually collapsed for year over year. It's negative 10% for used car prices. And this could be directly from this right here with delaying major purchases. So the car prices, obviously, if there's no buyers, you can't sell it. The price comes down. So if they aren't buying stuff, price comes down. You start to get massive flips here, and that could go for housing too, where the housing market, if there's no buyers, then you can't sell for whatever price you want to sell it. You have to lower your price until somebody buys it. And then also paying down debt. I mean, you should probably always be paying down debt, but that would make more sense. Planning to reduce holiday spending, allocate more money to savings, and staying in a job that they don't enjoy. So quiet quitting, the big topic everyone loves to talk about. Quiet quitting. Probably going to be the majority of people in work are just going to be quiet quitting. But big things that people aren't spending money, that's obviously going to have bigger effects on the broader economy. And overall, economy is not in a good state. And you can tell that it's not in a good state, especially if 60% of Americans living check to check compared to last year was 55%. So it's up from there. This is obviously major. The majority of people are living check to check. Doesn't matter really what your income is. If you make 100K a year, a million a year, 20K a year, everyone's living check to check, which is just kind of crazy to think about. And this is signs of an obvious weak economy, recession, and just things are not going well when you see numbers like 60% of people living check to check. And you have the largest annual gain on record for debt for the last year, which is the bottom 90% of people in the US had an increase of debt by $300 billion last year. So obviously people are massively in debt and incomes are massively down. Lots of inflation, less incomes, less discretionary income, massive debt. It's not a recipe for success. It's actually pretty bad. And obviously having the largest gain on record for the last year just shows that things are not in a good place at all. And also mortgage rates, a big thing to look at for obviously buying homes and stuff, and the price of houses that could happen is you see this overall trend here for the last, I don't know, 30 or 40 years-ish here. It's been trending down. You can see the obvious trend line here, just kind of continuously trending down to very low rates. And then we have this spring up where it's broken. It's now above this trend line down and it's broken above. So the question on this would be, are these rates at such a high level that something in the housing market breaks? And that could be a massive collapse in pricing as people can't afford to pay the average house price of like $450,000 or whatever it is now at a 7% interest rate. People can't afford that. So the price has to collapse during a time when people aren't spending money to buy these properties and stuff. So that leads to a massive drawdown in price where even if it was $450 for the average house, that was the price, at 7%, people can't afford it. You drop it to $400, $300 or $350, and people might be buying it then if you're in good economic times. But we're not. People aren't spending that. So you drop it to $350 and no one can still afford that or comfortably afford it. So now you have to drop it even more to $300, $250, and that could lead to a massive collapse in real estate prices and lead to a lot more problems too. So all in all, there's massive problems here and things that you shouldn't really ignore. And the Fed isn't a forward-looking organization, so they're going to compound these things by raising rates and continuing to raise rates regardless of what's going on with everything collapsing, and just something's going to break before they actually U-turn. But that's going to do it for this video. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. I'll see you guys in my next